Good afternoon, all. Welcome to our special edition of Business Insights, where a panel of industry thought leaders share their insights on the current economic landscape that impacts small to medium businesses in Australia in this pandemic and beyond. Our panel today consists of Ian Maclachlan from Imperium Accounting and Tax. Say hi, Ian.
Hi, Liza. Welcome, viewers. Thanks very much. I was just trying to unmute there, making sure that everyone's getting...
That's great. Still on Zoom, as always. Sam Ghoreyshi from Moneyclip Private Wealth.
Great to be back here.
Great. And myself, Liza Garrido from Enigma HR. We do have guest speakers that join us. However, today we are going to keep our format very simple as we have a lot to cover. In this webinar, we provide ongoing insights that entrepreneurs and SME leaders need to know to shed some light on the business decisions they make on a day-to-day basis. This is where business goes to know. As we have a lot to cover today, could I invite our guests to include their questions in the chat box? And we will address and have a Q&A at the end of our session today. Thank you. So it's very exciting time. So yesterday evening, as everybody knows, the Treasurer Josh Frydenberg handed down the 2021 to 2022 federal budget. It's his third budget, as we know. The Treasurer said that the Australian economy has rebounded at its fastest pace on record over the latter half of 2020. Nevertheless, the impact of COVID-19 will see the deficit reach $161 billion in 2020 to 21, improving to $106 billion in 2021 to 22, before further improving to $57 billion in 2024 to 25. He noted that the 2020 to 21 deficit is $52.7 billion lower than was expected just over 6 months ago in last year's budget. JobKeeper has certainly played its role with nearly 1 million jobs added since May 2020, he said. The government believes that this budget will consolidate these gains and put the economy on course for the unemployment rate to fall below 5%, reaching 4.7% by the June quarter of 2023. Real GDP forecast to grow by 1.25% in 2020 to 21, rising to 4.25% in 2021 to 22, and 2.5% in 2022 to 23. To reach these targets, the government has committed $291 billion in direct economic support for individuals, households, and businesses since the onset of COVID-19. The budget also adds to the government's existing infrastructure investment pipeline with a further $15.2 billion of infrastructure commitments. What I'd like to go through today is, at a glance, announce some key measures that impact small to medium-sized businesses. I'd like to start with the COVID-related measures. A further $1.9 billion will be allocated for vaccine rollout. And the news all over the place at the moment is the vaccination rollout in several hubs. The budget provides for $1.5 billion for COVID-related health services, including testing and tracing, respiratory clinics, and telehealth. With regards to tax, and Ian will cover this today, tax cuts for over 10 million low and middle income earners. These are individuals who will receive up to $1,080, and couples will get about $2,160 in tax cuts. That is excellent. In terms of housing, the government is to help another 10,000 first home buyers build a new home with a 5% deposit, some 10,000 single parents to purchase a home with a 25% deposit. Increasing that amount can be released under the First Home Super Saver Scheme to $50,000 from the $30,000, and to allow aged over 60 to contribute up to $300,000 to their superannuation fund if they downsize their home, freeing up more housing for housing stock for younger families. And Sam, I'm sure you're going to be talking about that as well. In business, the budget provides a further $2.1 billion in targeted support for aviation, tourism, arts, and international education providers. The tax relief is given around $1,000 to small brewers and distillers. The budget will double its commitment to the Job Trainer Fund to help create new apprenticeships and traineeships. I'll talk about that a little bit later. The budget is investing $1.2 billion to build digital infrastructure skills and cybersecurity, and launching a new patent box under which income earned from new patents developed in Australia will be taxed at a concessional 17% rate. The patent box will apply to the medical and biotech sectors. Ian, I'm sure you're going to shed some light on that. With regards to women, welfare and safety, $1.7 billion investment in childcare to help boost workforce participation. A new $1.1 billion funding for women's safety, which would deliver more emergency accommodation, legal assistance, counseling, and financial support. And it will remove the $450 monthly minimum income threshold for superannuation guarantee to help improve economic security for women. Now, I would like to hand over to Ian to talk about your contribution or your input on the personal and business related tax measures. Over to you, Ian.
Thanks very much, Liza. So what I'm going to do is I am just going to share a screen now where I basically want to talk about the personal income tax measures, and then after that we'll go on to the business taxation measures introducing the budget. Okay, so the first one, as you mentioned, Liza, is they've announced that the low and middle income tax offset, or otherwise known as LMITO, that's going to continue to apply for the 2022 income year. So this was legislated to only apply up until the end of the 2021 income year, with the result being that low to middle income earners would have seen their tax refunds in 2022 cut by between $225 and $1,080. So basically you can see there the table that I've got. So basically if your taxable income falls for less than 37,000, you would receive the minimum amount there of 255. And then if you earn up to $90,000, then you would get the maximum low income tax offset of 1,080. And that phases out down to zero between taxable incomes of 90,000 to 126,000. Now, where does this come in? This comes in when you lodge your tax return, okay? So when you input the data for your tax return, basically this offset is going to be calculated, and then that will form part of your refund or reduce the amount that you have payable based on your taxable income. The next one that I'd like to go through is the low income tax offset. Now, this is also going to continue to apply for the 2022 income year. So this was intended to replace the former low and middle income tax offsets from 2022, 2023. But this new LITO, L-I-T-O, was brought forward in the budget to apply from the 2021 income year. So you can see on the table there, the amounts of the offset. So up to $37,500, the amount of the offset is going to be the maximum of $700. And then you can see that it phases out right up to a taxable income of $66,668. So to work in conjunction, in conjunction with the low to medium income tax offset. And once again, this will be applied when you prepare your 2022 tax return. So next, they didn't announce any changes to the personal marginal tax rates. Now, they already brought forward the stage 2 tax rates to 1 July 2020 in the mini budget that they did in October last year. And the stage 3 tax changes will commence from the 1st of July 2024. So you can see here that basically the marginal tax rates are unchanged for 2022. So this is the one that I like to look at, the 45,000 to the 120,000 taxable income. So that will remain taxed at 32 cents. And then the top marginal rate, 180 plus, that then goes to 45%. And in the next table over here, I've basically got a summary of what these rates and thresholds are going to look like for the next few years. So 2021, we can see down here in the bottom, 2021, and then 2022 to 2023, 24, they remain the same. But then once we hit the 1st of July, 2024, you can see that this middle income tax bracket of 45,000 to 200,000, so it increases from 120 to 200,000 and reduces by 2.5% from 32.5 to 30%. And then the top marginal rate increases from 180 to 200,000. Okay, so no change there, but just a good bit of a recap on those marginal tax rates. Now, the next one from a personal taxation point of view is they've removed this $250 threshold for self-education expenses. So in prior years, let's say that you were doing a course that was related to your line of work, then let's say that course was $1,000. The deduction that you would have been entitled to receive would have been $750 because they've had an amount, a deduction in there for $250 that comes off any total course amount. That amount has been removed. So I think this is a really good change and I welcome that one. Once again, that occurs in your income tax return. So previously you'd have to put the amount in and then automatically the deduction of $250 would come off that total course fee. Going forward, that won't occur. So you'll be able to expense the full amount of that course as long as it's related to your current line of work that you're receiving salary and wage for. Let's move on now. So, okay, so basically what the government has done is they're going to replace the existing test for the tax residency of individuals, and they're going to call this a one bright line test under which a person who is physically present in Australia for 183 days, which is half the year or more, is going to be an Australian tax resident. So this is going to be the catch-all test now to determine residency, to determine what an individual then needs to put in their tax return. Now, individuals that don't meet the primary test, they're going to be subject to secondary tests that depend on a combination of physical presence and measurable objective criteria. Moving on now to business taxation. So, you know, they blew this wide open last year. Originally, it was the 30,000 instant asset write-off, then it went to 150, then it went to unlimited, and that was only due to go till 30 June 2022. That now goes to 30 June 2023, provided that the business is going to meet the turnover thresholds. So that temporary full expensing increases to 30 June 2023. So it's a really good, measure there. The government's obviously just trying to, it wants businesses to spend money on assets and obviously put it back into the economy. Now, okay, what they've also done is another important measure. So in the mini budget last year, they basically, they announced these loss carryback provisions whereby if a business was affected by COVID and they were to be in a loss position in the 2021 financial years or 22, they were able to then carry back some of these losses and get a tax offset if they had previously paid tax in the previous financial years. So this is now extending to the 2023 financial year. So it's another really important piece from a tax planning point of view. If you have made a loss during COVID, and now that extends to 30 June 2023, and you have paid tax in previous years, you can get an offset for that tax paid based on the losses made up until 30 June 2023 now. So the next one is the intangible asset depreciation. So prior to the budget, businesses had to use the effective life on their intangible assets based on a table that was produced by the ATO. Now the budget's confirmed that income tax law is going to be amended to allow taxpayers to effectively self-assess the life of these intangible assets. So these might be things such as intellectual property or in-house software. Once again, I think this is a really good measure because a lot of those effective lives in the published table were a little bit too long. So this is a really welcome measure. Liza, they're the major points. I just wanted to give a brief overview on the personal and business taxation. There are some other items in there which is going to be suited to much your larger and listed entities. I'm not going to go through those today, but if anyone wants to know any further information on those measures, please feel free to reach out.
Thanks, Ian. It's just so important to our viewers and our guests to really seek advice now. And as the budget is rolled out, or as all these implementation measures start to get more formalized, you really do need to talk to your accountants. So the question you really need to ask yourselves is, how often do your financial advisors or accountants speak to you in the course of the 12 months? And if you're not happy about that, you do need to do something about it. So that's good advice, Ian, in terms of reaching out to the people that you trust in your business, particularly with tax, both for business and personal tax reasons. Sam, over to you. I mean, what is the insight on superannuation and investments? Just unmute yourself, Sam.
Thank you, Liza. A great summary by yourself, and also a great taxation update by Ian. I'm going to take you through a number of different aspects related to those planning items. Firstly, I thought I'll cover off on super. There's quite a few items around super. First and foremost, the superannuation guarantee will move to 10% paid by the employers from 1 July. No changes to what's been talked about before. I should say that everything that we cover off today are part of the budget proposal. It still has to go through legislation through the Parliament and become legislation in due course. So obviously we may see some changes to these items, but given that it's quite pro growth, pro helping everyone out, I would doubt it that the Labor or other people are going to go against it. One of the big things that's been holding back some of the retirees is a thing called the superannuation contribution work test, where they have to be able to prove that they are doing a certain number of hours. This has basically been repealed, which is good for many people who are still doing some work, and that's really welcomed. There's been some issues in the past with the SMSF and a thing called residency rules and the control test. This has been extended to be able to provide up to 5 years, and that really helps with some of the people that are either not being active members or in fact they may have even been overseas. Now, there are a number of different income stream products, annuities, and so on. There's been a lot of issues with these in the past in terms of converting these and how they're going to be treated. Government is going to make it much easier to deal with those going forward. Some of these items are a bit complicated, not part of what we can discuss today, but by all means reach out about those items. A really big piece is, and this is going to really help women who do part-time work in particular, and that is the superannuation guarantee. Never used to be compulsory to be paid if you earn less than $450 per month. That threshold has been removed, and that's really great to see. We also have an opportunity for anyone who's doing a downsizing and from the age 60 upwards, for them to be able to get some of the proceeds of the sale of their house and be able to contribute that into super. For a couple, it'll be $600,000. Currently, there's a program called the First Home Super Scheme. This is going to be extended for withdrawals up to $50,000 from $30,000, which is obviously reflective of the fact that the price has also moved on as well. There have been some technical changes for tax and administration, so that's going to help in terms of getting that right going forward. One thing that is not going to be extended is a piece of legislation around victims of domestic violence. So previously, there was proposal for early release of super to these victims. However, the government has decided that's not the right course of action at this point. And there's been some updates to the pension loan schemes, whereby you're allowed to take 2 lump sums in any 12 months, up to 50% of what you can take. And again, this is going to help with pensioners who need a bigger lump sum of money, for example, to help them with fixing up their house, where the cost of fixing up the house is significant. From a housing perspective, there is a program called Family Home Guarantee, a new home loan scheme that basically allows single parents to be able to get into their homes with as much as, as low as 2%. There is a new home guarantee currently, which allows new home buyers to be able to get into their home with 5% deposit and not pay what's called lender's mortgage insurance, which is great. And they've also expanded the number of people that can take this up, so more people can get into their home. There's already been the first home saver scheme, which I've discussed in the past. And then the other one was a home builder, which actually came about because of the COVID. There was a 6 months construction commencement period requirement, given that there is so much more building activity at the moment, and not being able to get that sorted quickly enough. The government has extended that period to 18 months, which is going to be really great. So I guess what we could easily say is that with some of these initiatives, obviously low interest rates as well, property growth may continue for a bit longer, I would say. There's been some specific announcements around aged care and travel in particular, and childcare. Quite a bit of money going into reform of residential aged care in terms of improving their safety and quality care, which is good. A big one is providing 80,000 extra home care packages so all Australians can stay at their home longer, and further training as well from that perspective. Something that's going to be good for our domestic economy and the travel industry is the half-price domestic flights that the government is offering. 800,000 flights in total, of which 660,000 has been sold already. In terms of the travel and hospitality, international students had a cap on how many hours they could work per fortnight. This has been removed, and obviously that's going to help in lieu of the fact that our borders are closed at the moment. And certainly with the childcare, the $1.7 billion package that they've announced means that more people, in particular mums coming back from having children, to get back into the workforce, and of course a bigger workforce is always well. Now onto the market. So this particular budget, as I've seen it, is very much what they call expansionary and very pro-growth. It's going to address the areas that are under pressure. It's going to help our economy to get back to normality much quicker than many other countries around the world. What I've seen is that government is very committed to growth and support for the economy, and they've balanced that short-term goals of getting that done as opposed to the long-term cost of having this sorted. Of course, there will be an end to all the support, and there'll be a period in time in future where we do need to make sure that we get back to a better balance. Currently, the budget position is better than expected, which is great. Peak debt was expected to be at 40.9% of GDP versus what they originally thought it would be 43.8%. It is worth noting that pre-GFC, in the Costello era, we actually had no government debt, right? So quite a considerable change to that point. Now, the policies that's coming out will have some impact on some of the industries. And so these particular industries, aged care, childcare, housing, travel and education, infrastructure, and of course, anything to do with taxation is going to benefit, and there will be a flow-on effect to the share market as well. I would say that this particular budget is definitely business friendly. It probably won't make the market move on its own or contribute to the Australian dollar going down a lot, which is obviously is going to be really great for us who live in Australia. So I would say that we would expect tailwind, and tailwind means we're going to go faster. Banks, property, travel, and infrastructure industries in particular are going to do well out of it. And of course, employment growth is very well welcomed. Obviously, the more taxpayers we have to help with the economy, the government collects more taxes, and we can get back to some type of surplus, or in fact, reducing our deficit over time. And I thought I'd just share this one last piece with you. So from a unemployment rate perspective, as you can see, we've had a strong period of downturn in terms of unemployment since we've got back to from the pre-COVID area. And you'll see that we are trying to get back to that 4.5% unemployment rate, which would be amazing feat for us to be able to achieve over time. It'll be interesting to see. We haven't had as what you would call a proper recession since 1992, almost 30 years ago. So we have to count ourselves pretty lucky to be living in this country. And with that, I'm going to pass you over to Lisa.
Always informative, Sammy G. Thank you for that. And speaking of employment and employment-related issues, I'm going to do my presentation just by showing a quick diagram, really. There's quite a lot to cover, but I'd like to, quote unquote, give that phrase that Josh Frydenberg has said, the budget is all about jobs. And truly it is. So the employers will receive incentives to hire young people as part of the $74 billion job maker plan announced in the federal budget. It's one of the several measures that the Treasurer says will help reduce the unemployment rate to 6.5% by the June quarter of 2022. And Sam has just showed you that graph to indicate that. So the job maker hiring credit will be available to employers for each new job they create in the next 12 months, from which they can hire an eligible job seeker aged 16 to 35 years old. For 12 months, these employers will receive $200 or $100 per week if they hire an eligible young person, again, aged 16 to 29 or 30 to 35 years old, respectively. New hires must work at least 20 hours per week, and all businesses except for the major banks will be eligible. So employers obviously have to demonstrate they have increased their overall employment to receive the hiring credit. And this will be evident in the single touch payroll system that all small to medium-sized businesses should already be using. So at a cost of $4 billion from 2020 to 21 to 2022 to 23, the scheme aims to support a massive 450,000 positions for young Australians. This is absolutely impactful. Now, when it comes to women's participation in the workforce, this has obviously been addressed in this budget. Obviously, we all know that women's jobs have been disproportionately impacted by the pandemic. And this budget, or the government, is determined to see women's workforce participation return to pre-COVID highs. And that is by, I'd like to discuss two elements there: repairing and rebuilding women's workforce participation and further closing the gender pay gap. I'd be interested to see how we're going to do this, by the way. And obviously, greater choice and flexibility for families to manage work and care. So Sam touched on that slightly with the paid parental leave scheme will be extended to provide access where eligibility has been impacted by COVID-19, and reducing these disincentives to go back to work. The investment in the $1.7 billion to make childcare more affordable will add up to about 300,000 hours of work per week, which is equivalent to around 40,000 women working an extra day per week. That is a good start, should I say. Also, there is further funding to support more girls and women to enter and stay in STEM jobs. For those of you who don't know that, these are jobs related to the fields of science, technology, engineering, and maths. So the childcare subsidy that Sam mentioned earlier will be increased to 30 percentage points for the second or subsequent child, up to a cap of 95%. So the removal of this childcare subsidy annual cap will reduce barriers again to working, and with these families and single parents will not be penalized by hitting the cap. Now, with regards to upskilling and reskilling, while the job maker plan includes the establishment of a budget this year, it's $1 billion in job trainer funds to position the workforce for recovery and beyond. So the job trainer fund will support up to about 340,000 free or low fee training places for retraining and upskilling. So the Boosting Apprenticeships Wage Subsidy aims to support up to 100,000 new apprentices and trainees, by paying employers up 50% wage subsidy, and that is to cap at 7,000 per quarter for commencing apprentices and trainees. So this is obviously a massive investment again in upskilling and retraining. But the government is also creating a new digital employment services platform to help job seekers find employment and training at the cost of $296 million. This platform will provide responsive and individualized support to online job seekers. This is what the budget is telling us. Now, in terms of attracting overseas talent, I think the government is introducing tax changes to encourage highly skilled individuals to relocate to Australia. Now, this is in my perspective. This for me, we need to see this roll out because the borders obviously are not scheduled to reopen supposedly until mid next year or 2022. So I'd like to see how this will unfold. Currently, we are all experiencing a very tight job market because of the skill shortage and talent shortage that all SMEs are experiencing, with particular note that the larger organizations, the larger businesses are actually looking at retaining their staff by counter-offering measures that they're putting in place. So us in SMEs are challenged in attracting new talent in the workforce. So in summary, I feel from an employment and HR perspective that this is definitely a confidence building budget with the skills development, the employment backing and the wage subsidy schemes. And I would like to see how this all rolls out with any changes as the government announces further initiatives in their approach to workers' rights and conditions. So that's it for me from employment and HR. Now, do we have any questions from our panel? Ian, would you mind just checking if we have any questions in the chat box?
We don't have any at the moment, but viewers, if you do have any questions, please ask them now and we will answer those for you.
I was going to say, Ian, whilst we're waiting for that, some of those measures, in particular the carryback losses and the instant write-offs, that's going to have a significant impact from a cash flow perspective to a lot of businesses, won't it?
Oh, absolutely. I mean, you know, they're obviously, I'm really glad that they've extended that loss carryback to include 2023 as well, because there's obviously going to be flow on from the effects of the pandemic into those years as well. So it's good that they've acknowledged that. Instant asset write-off. Yeah, I mean, look, once it hit 150, it was great. Once it hit unlimited, it was great. And now that that's going another year is even better as well. But, you know, they're obviously just trying to stimulate the economy and get businesses to spend. One thing that I will say on that is remember that you are still only going to be saving 26% of your money, because that's a tax rate that we're currently in for the corporate environment. So only buy that asset if you need it.
Well, indeed, yes. There's no point in spending $1 to get just to get 26 cents back. Yeah, that's for sure. It's got to be useful. And Correct. Can I also confirm with you, Ian? The carryback is for anyone who qualified for COVID, whereas the instant write-off is for anyone.
Correct. So the instant asset write-off is for anyone. The loss carryback is for anyone that did have a loss. Is going to have a loss in the 21, 22, or 23 income years that paid tax previously. Yeah, they're qualified for JobKeeper. Yep.
I'd also like to kind of emphasize with the job maker. I get a lot of inquiries about these. Your criteria for qualifying in the job maker credit really is that the individuals that you are looking to hire should be job seekers or have received a job seeker payments. And I think a lot of businesses forget that that's a real qualifying criteria. And obviously this is aimed at making sure that the young workers that were absolutely impacted in the downturn just get back up to speed and look at getting their careers back on track. So I just wanted to highlight that for our viewers and those that will watch this post recording today.
It's, I think, is it maternity leave payments as well. Women that were on maternity leave payments prior as well. I think they can qualify for
Yes,
job
correct.
making.
Correct.
Yeah. Them and job seekers.
Yes, that's right.
Yeah.
That's correct. And I think there's been an uptake on that for some of the clients that I deal with. There is obviously a process to qualify. So it's, again, I just emphasize, you know, the people here in the panel today, I mean, we have established businesses, we have our clients, and you, our viewers, will have your providers and suppliers. Do reach out to them. It is absolutely imperative, particularly with the announcements recently and how it would roll out and play out in your own businesses. If you have any questions, furthermore to this, we will be posting this recording on our Facebook page, Business Insights, and on our LinkedIn page called Business Insights as well. We will be sharing some of the snapshots, if you like, on our Facebook page as well, all of the presentation slides, just so you have a bit of a snapshot on what we discussed today. We don't seem to have any questions at the moment. So on that note, at 12:38 today, I'd like to thank all our visitors for watching. Thank you for supporting Business Insights. And until the next episode, thank you very much and have a good afternoon.
Thank you.